Due to the limitations of small scale and poor flexibility, it has become highly favored. There has been a shift from greenfield investment building a new enterprise to greenfield investment and merger and acquisition, merging or acquiring an existing enterprise, which combines direct investment with new indirect financing methods, especially utilizing the international capital market. A clear example is that foreign investors have established private equity funds targeting China overseas through joint ventures, investing in equity of Chinese enterprises through acquisitions and other forms. Foreign mergers and acquisitions blur the boundary between direct and indirect investment, inevitably leading to statistical differences. From the historical data of most countries and institutions, foreign mergers and acquisitions, as a new form of utilizing foreign capital, have become an important component of FDI. FDI has received much attention, indicating that attracting investment is still a booster for the rapid development of the world today. Whether it's developed countries. As a developing country, foreign investment is still one of the most effective means to create jobs. According to the statistics of the Bank of France, the amount of foreign investment and mergers and acquisitions in France in 2007 reached €100 billion, basically consistent with the data of the United Nations Trade and Development Commission, creating more than 30,000 jobs, the third best year since 1993. In this way, whether it is the statistical results of the United Nations Conference on Trade and Development or the conclusions compiled by the consulting agency OCO Global, China's problem is not whether the foreign investment utilized in 2007 was comparable or even surpassed by developed countries, but whether China still regards foreign investment as a monster to some extent. Since the beginning of the new century, due to the frequent occurrence of foreign capital mergers and acquisitions in China, its share of China's total FDI has reached about 20% from 5.5% in 2000 to 2005. Finally, when Carlyle wanted to become the owner of XCMG in 2006 and SEB in France wanted to acquire Supor, a big debate about beheading foreign capital was triggered. The threat of foreign capital has spread from the daily chemical industry to the equipment manufacturing industry, and recently to the grain and oil processing industry. At the same time, various external restrictions policies have emerged, such as the introduction of 3 policy provisions in 2006 that involve strengthening the management of foreign mergers and acquisitions. In 2007, the catalogue for the guidance of foreign investment industries was revised to include all investment activities in the real estate industry in the restricted category, and significant. However, due to the fact that land property rights in China are only 70 years old and the reform of state-owned enterprise property rights is not yet in place, the short-term behavior of foreign investment is relatively serious. For example, Goldman Sachs and Citigroup, which entered the Chinese real estate market in the early stages, have begun to sell their assets. As for whether capital can enter and exit quickly, in China, it is understandable to first strengthen one's own strength and gradually open up capital projects. However, since the second half of last year, a large number of South Korean enterprises have illegally withdrawn, in addition to increasing production costs. According to a survey by the Korean Chamber of Commerce and Industry, South Korean enterprises not only have complicated liquidation procedures when withdrawing, but also need to supplement the payment of land use fees and reduced taxes. In addition, some local governments do not provide assistance, resulted in Korean companies leaving without saying goodbye. In fact, due to the fact that the illegally evacuated Korean enterprises are mainly concentrated in traditional labor-intensive industries with low technological content, high pollution, and high energy consumption, the inability to smoothly import and export funds is not conducive to China's elimination of backward foreign investment and industrial upgrading. Obviously, how to treat foreign investment is no longer just a matter of quantity or utilization, but also a safety issue of being utilized. This change in attitude is becoming the key point and starting point of the important dividing line between China's first 30 years of forced reform and transformational reform, and the next 30 years of opportunity reform and proactive reform. Now it seems that there is little chance that foreign investment will miss out on the great opportunities for development like a raging beast in a flood. It will trap the reform ideas, and the consequences of continuing to stay in the version of the first 30 years are even more incalculable. Restrictions were imposed on foreign investment entering the service industry and resource metal industry. But the key to the problem is that financial innovation is emerging endlessly, which cannot be blocked. Due to the above direct and indirect investments with the help of the international capital market and various financial innovation, such as the purchase of Chinese concept rights real estate investment trust funds, large-scale subscription of shares of overseas listed Chinese enterprises, and overseas equity transactions or buyout equity acquisitions. Foreign mergers and acquisitions are still like fish in water. The Office of the China Real Estate Index System pointed out that the phenomenon of office building mergers and acquisitions in 2007 was not significantly affected by the external restrictions policy. In the first half of 2007 alone, foreign investment in Shanghai's real estate transactions amounted to nearly $1.3 billion, while in 2006, the overall foreign acquisition amount in Shanghai was $1.9 billion. Data from the Ministry of Commerce of China also shows that the actual of foreign investment used nationwide in 2007 $82.658 billion, a year-on-year increase of 13.8%. Moreover, if we continue to regard foreign investment as a scourge, the China concept will miss a major historical opportunity. When the American concept as a self-challenging advertisement, and a subconscious convergence of ideas about intentions, goals, and dreams, attracted tens of millions of immigrants, whose power and talent in turn promoted the development and success of the United States. Success is the achievement of the American dream. Now, the American concept is wavering. If China can create a Chinese dream like the United States when it created the American dream, that is, open up a main battlefield of you have me, which can not only meet the needs of the global surplus capital to seek a reasonable evaporation way, but also meet China's own industrial upgrading, management update and capital market improvement, such as the lifting of untraded shares bans faced by the stock market, the need for pressure such as refinancing. Finally, and more importantly, demonizing foreign investment implies a linear thinking, root of either good or bad, either this or that deep-rooted. But the reality is that it is not the problem with foreign investment, but rather that our own stage has not yet been upgraded or expanded. Generally speaking, asset permanence, high investment returns, and rapid capital inflows and outflows are the three fundamental elements for attracting foreign investment. At present, besides having high investment returns, China does not yet possess the other two major elements. Firstly, a permanent and clear definition of property rights is conducive to attracting more foreign investment through equity mergers and acquisitions, as well as keeping foreign investment in the region for a long time to serve its economic growth. Treating foreign investment as a raging beast will make immeasurable historical mistakes regarding global foreign direct investment (FDI) in 2007. There were serious disagreements in the reports released by the two institutions according to data from the United Nations Conference on Trade and Development. Global FDI reached a record high of $1.5 trillion in 2007, with 2/3 in developed countries and 1/3 in developing countries. The United States led with $193 billion, followed by the UK with $171 billion, and France with $123 billion. China is still the leader in developing countries on the contrary, according to data from consulting firm OCO Global. Although global FDI increased in 2007, it was still less than $1 trillion, while China surpassed the United States as the most favored foreign direct investment destination with a $90.4 billion investment attraction. How to interpret two sets of data and two conclusions. In the era of capital factors, the differences in FDI data first reflect the following issues. Firstly, the ranking of investment attraction is based on a manifestation of the country's ability to attract foreign investment and its trends. It is evident that different institutions have different judgments on China's performance in this regard. Looking back, foreign investment has a Matthew effect. Inconsistent plus irons add some variables to the choice of foreign investment destinations in the future. 3. The concept of a virtual economy with financial civilization determines its attractiveness and even a country's position in international economic activities. The moment is coming to test the emerging markets and China concept. Secondly, the data fight is related to the new trend of global utilization of foreign investment. International experience shows that utilizing foreign investment, the approach is related to the stage of economic development. In the early stages of economic development, there are bottlenecks such as production technology, management experience, and overseas markets, and direct investment that solves these difficulties has become the focus of utilizing foreign capital. With the increasing maturity of industry and the expansion of domestic and foreign markets, indirect investment portfolio investment is not subject to direct investment regulations. Future countries will be extremely sensitive to food prices, and control the rise in grain prices will become the focus of policies in various countries. In the short term, international grain prices may rise or fall due to the government's efforts to control the situation by increasing energy market supply and introducing subsidy policies. But food prices have actually embarked on the irreversible path of oil prices, and what countries are doing with oil prices now may follow suit in the future. Oil prices have prompted countries to jointly reflect on energy policies. And future food prices cannot be fixed by a single country adjusting its policies. Multiple leaders have engaged in a food summit, but measures to stabilize food prices in various countries may be resolved through genuine interests. More importantly, unexpected events such as natural and man-made disasters, financial turmoil, etc. will increase the dispersion of future food prices. As for whether international grain prices will rise and fall, whether they will remain at a high level or return to normal, it depends on the combined force of various uncertain factors, especially whether countries can reach a consensus on the issue of grain prices consistent. Nowadays the oil price has not yet unified the front line, and the solution to the food price problem is clearly even more elusive. Therefore, in the long run, both the country and the market will keep up with food prices, and international organizations may play a greater coordinating role. And China has clearly become an oasis in this food price tsunami. The increase in domestic grain prices is relatively flat, stable, with an increase of 6.8%, 7.4%, and 11.4% from March to May, respectively, because the self-sufficiency rate of grain in our country is as high as 95%, and the 150 to 200 million tons of grain reserves make the Chinese people have food in their hands and have peace of mind. More importantly, China's grain prices have not yet been liberalized, and the firewall of price controls has isolated the soaring international grain prices. In addition, the government has taken measures such as transferring grain from the north to the south, reducing exports, and raising the minimum purchase price of rice and wheat, so that China has not fallen into the vortex of the international food crisis. But after all, the current prices of rice and wheat in China are only about a quarter and one-third of the international prices, and the gap between domestic and international grain prices is constantly accumulating upward. Why? In order to stabilize food prices since March, China Storage Grain Corporation and COFCO Group have sold wheat and rice in. There is already upward momentum in adjustments, but the qualitative change in food under the impact of civilization has accelerated its recurrence of the oil price mistake. On the one hand, biofuels endow food with energy attributes, exacerbating the contradiction between grain and oil substitution and the competition between people and vehicles for food. 70 liters of biofuel consume a person's annual rations but can only drive a car forward for about 700 kilometers. The World Bank predicts that corn ethanol can save 2% of global oil consumption, but it will cause a 30% increase in food prices. On the other hand, food prices are distorted by the highly financialized capital system. Wall Street speculators have become the world's largest hoarders of food. In 2007, half of the total output value of corn, soybeans, and wheat in the United States was held by buyers of agricultural futures, and agricultural funds exceeded $150 billion. Capital speculation enlarges the imaginative space of grain prices, allowing futures prices to lead the trend of spot prices, and controlling the rise and fall of grain prices is as easy as pie. Grain prices are clearly embedded with unstable genes, and once anomalies accumulate to a certain extent, they will release risks. The release of this crisis reflects the complete ecosystem of economic civilization. The development of industrial economy, financial civilization, and other alienated agricultural food attributes undoubtedly turn to agricultural civilization for strong retaliation against industrial civilization and other civilizations. This kind of backbiting has made grain a strange attractor of instability in the world, even in the United States. There has also been a rice rush in China. In fact, food is becoming a more powerful political weapon than oil, rewriting world politics. Southeast Asia, used to be the world's granary, however, has weak disaster resistance and high fertility rates. Agriculture is mainly focused on labor-intensive crops, while ideas remain stuck in the agricultural era, and its vulnerability has been exposed in the rice crisis. The United States, on the other hand, is uniquely endowed with not only 13.15% of the world's arable land, forming a large-scale agriculture with large-scale planting and industrial management, but also the ability to turn the tables in the financial market and seize the commanding heights of genetically modified crops in agricultural technology. This gives the United States both capital and strength to wield food weapons. The corn ethanol strategy implies an international strategy. On the one hand, the United States consumes excess corn under agricultural self-sufficiency and monopolizes the pricing.